5 ways the brain can trick us, and it's taken from this Nobel Prize winning book, Thinking Fast, Thinking Slow.
Money, mindset.
This is Millennial Money Mindset. If you want the fruits, you need the roots. So we're going to talk about how the brain can trick you when investing. So investing is very much a mind game. So you want to have more control of yourself than the market, because your mind can play tricks on you. So behavioural economics has come on massively in the last 10-20 years, and I think your mindset is the most important thing, or that you can control in investing. The most important thing you can get handled with investing, because you can control your mind, you can control yourself and your actions. You can't control the market. So today we're going to go through 5 ways your brain can trick you when investing. So part of it's taken from the book Thinking Fast and Thinking Slow by Daniel Kahneman. It is a hefty book. He won a Nobel Prize for it. I've highlighted loads in here so to kind of cover the stuff that you don't necessarily need to read. It's an academic book, so it's pretty heavy going. I brought this on holiday thinking that, I can give myself some time to read and kind of reflect. I was like, Neil, why don't I choose a nice kind of nice easy fiction book? But this kind of is what I brought, and I did get through it, so I'm bringing you this video. So hopefully I'm giving you value. If you do find value in this video, please like, please subscribe, and please tell a friend about Millennial Money Mindset. So this is going to help you reduce your stress and worry. This is going to get you closer to your goal of being financially independent, and it's going to save you money. So it's going to make you avoid costly errors and buying at the wrong time or selling when you shouldn't. So my name is Neil Doig. I am the author of Millennial Money Mindset. If you want the fruits, you need the roots. The creator of Football Formation, Asset Allocation, and my company is called Money Tips, which stands for tax, investment, property, pension, savings. And we're different. We offer financial coaching, so we offer one-to-one coaching, we offer group coaching, and we're launching our accelerator program. So that's exciting news for us. So more news to come about that. So this book. So the 5 main points. So basically, we as humans are rubbish investors. So when we understand this, it's going to really help our investing. So one of the first big takeaway is overconfidence. So Daniel Kahneman basically studied loads of different traders and taking data going back for quite a few years, and it's quite kind of looking at the kind of psychology kind of side of investing and trading. And he basically kind of boiled it down to a number of ways that our brains can play tricks on us. So once we understand this, then we can actually realize that this is kind of a cognitive bias, and that we can adjust and change our behavior to take into this new knowledge and help us to get all those benefits that we talked about previously. So overconfidence. So everyone is overconfident. So if you think about our sex life, most people would say we are better than we think we are at sex. So if you did an interview, I'm sure if they did a survey, most people would say they're above average when it comes to that in our relationship, etc. And that's mathematically not possible, because everyone can't be above average. It's got to come to a point where we're all kind of out there, be like an average point. Obviously there are going to be some people better, some people not, but we're kind of humans. We always kind of overconfident. We have overconfidence, and it's the same with our investing. We think we're better than we are, especially looking at some of the evidence is kind of it's crazy to see how much people try to beat the market and they end up actually losing out to like an index tracker that just tracks the market. And this also applies to fund managers. So fund managers charge hundreds of thousands of pounds over your lifetime just to supposedly beat the market. And if you look at the evidence and look at historic kind of results, this isn't the case. So we are rubbish at investors, and it's not our fault. So we weren't taught the basics at school. So there's certain principles around money, how money works. Money is just a technology. Once you understand it, it's like any other technology. It's like the internet. So understanding ourselves and our behavior, how we're wired as humans, can be really powerful with our investing. and I talk about much more in my book, Millennial Money Mindset. We are rubbish investors, and once we understand that, then we can almost take steps to reduce our kind of the ways that our brain tricks us. So the first way is being overconfident. So just understanding this is super important. So the market is investing is very counterintuitive, which means that it often doesn't make sense like we would logically think that it would make sense. And we have to almost think backwards, which doesn't maybe make sense initially, but when we understand it, it's super powerful. So it's a bit like at the moment, markets are at all-time highs, so markets are almost like crazy priced, are kind of priced crazily, and we're in a kind of the deep recession, so almost one of the biggest recessions in the 1930s. So how is this possible? How can that logically doesn't make sense? So how can markets be at all-time highs and be in a recession? Surely if it's a recession, markets should be low. But there's a number of different things, like it's priced in, or there's nowhere else better to put our money. We're getting zero interest rates, so people are almost encouraged to invest. There's money printing, which means that money's worth less. The pound coin in your back pocket is worth less than inflation's eroding the pound coin in our back pocket. So actually investing into the stock market is the better choice. It's the kind of the less of two evils, so to speak. So understanding this and understanding that it doesn't make logical sense sometimes can be really powerful with our investing. So that's number one, that overconfidence. So number two is hindsight biased. So this is basically looking back in the past and thinking that why did someone else make that decision? Why was that decision in the past? It's having information in the present that we didn't have when we made the decision in the past. So I used to trade gas for a FTSE 100 company. I would trade every day, and we would have to log down our trades every day. So I'm buying this at this price, and we'd have to give a rationale. This demand is this, supply is this, so price is going to go up. If there's a higher demand than there is supply, then prices logically should be going up. Why is this? Why did you buy when you should be selling? And it's hindsight bias. So having information in the future and looking back, it's so easy to make decisions when you have that information. So that's having hindsight bias. So the next thing, the way our brains can play tricks on this, is biased judgment. So we all have our own biases. We all have our cognitive biases, or we have our own kind of individual biases. So in the book, he basically flipped a coin loads of times, and they tried to get people to predict the outcome of this coin flip. Obviously that's impossible, it's just a 50-50 chance. But there was the people who he interviewed and he studied basically thought they could control that decision, and obviously that's impossible. But we have these kind of biased judgments that we think we can control things that we can't. And the same thing happens when we're investing. We often think that we can control, or we know more about the market than we actually do. We think that we're cleverer than we are, and we think that we have certain information that means that we can predict where the market's going to go, and that's not always the case. So we can also fall in love with a company. So maybe you bought Apple, for instance, and kind of followed their path when kind of Steve Jobs came back to Apple and kind of saved the company, or we love to fall in love with the stock, and we might make really bad decisions on the back of this. So we're all biased, and we have to understand that we're all biased in our judgment, and understanding this is super powerful. So the next thing he talks about in this book is herding. So essentially, we love to do what others do. So we love to be in a herd, and we often don't like to go against the grain, or don't like to speak out against what we think is the group. We kind of fall into this fallacy of kind of groupthink. We don't want to be the person that says that thing isn't right, or that thing isn't quite as it is. So yeah, we don't want to look foolish, and yeah, this can really affect our judgment. When Bitcoin is a good example of this. So people now think Bitcoin is great. Big institutions are buying into Bitcoin, but at the time, people laughed at people. I know I had a client, he made £15 million of Bitcoin winnings. I went and spoke to a number of law firms or accountants, and they kind of laughed at me by saying, what is this Bitcoin? Is is it kind of made up currency, or why is this kind of made up currency? But obviously today it's almost been taken seriously, and it's the people who go against the grain or go against the conventional wisdom that are going to make money. So this guy made £15 million in his Bitcoin winnings because he bought it at peanuts. I've made thousands from Bitcoin. I sold at kind of the top, and I should probably have almost regretting I should have probably just kept in, but I kind of took my winnings and I've reinvested them into other investments. But yeah, going against the grain, sometimes that's what you need to do with investing, but it's super scary. It's scary to go against the grain. It's scary to go against the herd. It's scary to go against the group where you don't want to look silly or foolish. So that's the next way that the brain can play tricks on us. Sometimes we don't want to go after the job that we want because we feel like maybe our colleagues are going to laugh at us because we're going to do something that we actually love, and that's the kind of toughest decisions, or some of the best decisions we make. So that is herding. And the final one is loss aversion. So what is loss aversion? It's essentially we feel more pain where we lose something than if we'd won similar gains. So let me say that again. So loss aversion is where we feel more pain from losing something than we would have got if we'd got the similar winnings. So if I had lost £100 on the stock market, I'm going to feel 2.5 times more pain than the similar pleasure that I would get if I'd won or I'd gained £100 in the stock market. So it comes back to where we evolved as humans. We're more likely to stay alive if we're going to run away from the scary bear. So a loss aversion is super important, and this is why so many people, when the market crashes, people get this they get what they call loss aversion, and they want to get out of the market as quick as possible because they're feeling this pain. This pain is much more intense than if we've got the similar gains of greed or that people get when the market goes up. And it comes down to how the brain's wired. There's a thing called the amygdala, which is part of the brain, and a chemical gets released in this part of the brain called the amygdala. And that's why we have this loss aversion. And understanding this is super important when you're investing. So it's knowing to hold firm when the market's coming off. If you're thinking 10, 20, 30 years time, if you're investing for this long-term period, you must understand it's a long-term process. It's not just, you're not just buying ups and downs of the market, trying to time the market, because as we've learned from number one, we think we're better investors than we actually are. We have this overconfidence. So let's go through those in turn. So number one, we're overconfident when we are investing. So we think we're better than we are. So that's number one. Number two, we have hindsight bias. So looking back, we almost seems obvious when we look back, but when we have that information, when we have to make that decision in the moment, we don't necessarily have that information that we do have in the future. So we have this hindsight bias. So number three is we're biased with our own judgment. So we think we can control decisions when we can't. Number four is herding. We like to go with the herd. We don't like to step out and think for ourselves. We often don't like to have this critical thinking, and we get kind of caught up with the groupthink. And then finally, loss aversion. So we feel pain much more impactful and much more painfully than we would with a similar amount with the gain that we get. So that is 5 ways the brain can trick us, and it's taken from this Nobel Prize winning book, Thinking Fast, Thinking Slow. So thanks so much for watching. Please like, please subscribe, please tell a friend about this channel, Millennial Money Mindset, if you want the fruits you need, the roots. Which one of these, please write in the comments, which one of these have you been, have you had before? Which have you been successful doing? Have you fallen for as well? Have you ever kind of had hindsight bias where you've thought in the past, oh, why did I make that decision? Have you followed the crowd, been herding? Maybe you realise you are overconfident and you need to get some coaching to get the kind of learning principles. So we at Money Tips offer one-to-one coaching, and we offer kind of group coaching as well. Yeah, so hopefully this has been useful. Hopefully I've given lots of value to you. Please like, please subscribe, and please tell a friend about Millennial Money Mindset. If you want the fruits, you need the roots. Thanks so much.
Money Mindset.
I think that sounds alright.